Hey, I always talk about this, and I wanted to just shoot a quick video. This is a strategy to save yourself a ton of money on interest payments towards your mortgage. All right, so I want to show you this. Now, when you talk to lenders, they're gonna structure the down payment, and they're gonna structure the uh, PMI, which is private mortgage insurance, up front. So they're gonna tell you, hey, put 5% down, put 10% down, put 20% down. And in most cases, if you're a consumer and let's say you have an account and you have enough to put down 40% towards a mortgage, you're gonna think to yourself, let's just put that down now, okay? If I'm getting $100,000 loan, let's put down $40,000, and then I only have to mortgage $60,000, right? That's what you would probably be thinking. And I would tell you that that's a mistake. And it's a mistake because you can actually save yourself a ton of money on interest if you do this. And I'll show you exactly what I mean. And it's all based on mortgage graphs and how they operate. All right. Now, I'm going to share my screen, but just to make things a little bit more simple, we're going to run it off of a $100,000 mortgage, and so we'll change this to $100,000, and we're going to assume that you're putting down 20%. Okay, let's calculate this out. All right, now the thing is that when you get a mortgage, there's a thing called private mortgage insurance, and they do not erase private mortgage insurance until you put down 20% or there's 20% equity in the property. All right, now there is certain circumstances where you have a high credit score or something to that extent, and then you can actually you won't have PMI with a lower down payment. So the point of this is that whatever down payment you could put, the minimum amount of down payment you could put towards your mortgage and still avoid PMI, the better off you're going to be. Okay? If you don't have enough money to put down PMI, like you say the max you could put down is like 7% towards a mortgage, okay? And there's no way for you to avoid PMI. And you ask your lender, what's the minimum amount I could put down? And they say, well, your credit score is good enough, you could put down 3%. All right, in your mind, you might think, well, let me put down 7% instead of 3%, but I'm telling you, you should put down 3%, and I'm going to show you exactly why, okay? But just remember, you want to get the minimum amount of down payment possible with being able to eliminate the private mortgage insurance if you can, okay? And also, you're going to have to be able to afford it, afford the payments per month. The lower down payment you put down, the higher the monthly payments. But over time, you'll save yourself a ton of money if you can swing it. And let me show you how this works, okay? So here's the here's a home value based on. Let's just put this down payment at zero. Actually, let's redo that. Put this at zero. So these figures are going to look like this. You're getting $100,000 loan amount. So it's like a VA loan. Okay. So it's into 2024, but let's look at this. Okay. So this is a mortgage graph right here. This whole thing right here is a mortgage graph. This is year one all the way to year 30. And what this is this top part is the amount of money you pay towards interest, and then this is the amount of money you pay towards principal. So you see they're about 50-50, about 15 years through. All right, it gets to about 50-50, 15 years through, and it shows you how much money you're going to pay towards the mortgage amount via the principal and via the interest. Now, if you took and just to say that you can get 100%, you can get $100,000 and you don't have to put anything down, $0 down. All right. And you say, well, I have $50,000, Phil. Why don't I just put that towards the balance? And I say, well, can you afford the payments on a $100,000 mortgage without putting the $50,000 towards it? And you say, yeah, I can afford it. Okay. And they're not, and let's just say under these circumstances, you're not going to have to pay PMI either. Okay. So you're getting a $100,000 loan. You don't have to put any money down, but you do have a lot of money, but you don't put it down, and they're not going to give you PMI. Okay, let's just say that's the circumstances, best case scenario. And you'd say, well, why not? And I'd say, well, just get the loan and then put the $50,000 towards the balance and watch what happens here. All right, so when you do that, when you get your mortgage statement from your lender, it's going to give you every single payment you make. every single month over that 30-year period, and that never changes. It doesn't change. If you take and you put and you just pay it on schedule exactly how they laid it out for you, it'll be exactly the way it shows on that paper. The only thing that can change that paper is if you put more money towards the balance remaining that's owed to the bank, not towards the interest, but towards the balance. If you dump money towards the balance, what it does is it takes the graph and it just pushes it into the future. Okay? So in this case, like say you have a $100,000 purchase and you have $50,000 in a savings account, and you said, I'm going to take that $50,000 and I'm going to put it towards the remaining balance on the mortgage, which what that would do would pull this graph all the way to year 15. Okay? So it would take you 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, right here. All right? So at this point, what you see here is the principal. When you make a payment, okay, there's $3,154 going towards principal per year. And now there's $3,105 going towards the interest per year. Okay? So at year 15, you go from making more money, paying more money towards the principal than you do towards the interest. So the first 15 years of that mortgage is mostly being contributed to interest only and not to the principal. And it's really, really heavy in the beginning of it. Like, look at this first year. You're going to pay $4,710 towards the interest and only $1,550 towards your principal. All right? So what I'm telling you is that if you had a $100,000 loan, you had $50,000 in savings, and you dumped $50,000 onto the balance, it'll pull you directly to year 15 right here. And now you've saved yourself. If you went back through this and you looked at every single year and you added every single one of these up on your documents, you would see that you save here. Year 1, you save $4,700. Year 2, you save $4,600. Year 3, you save $4,500. So you can actually calculate exactly how much you will save if you put that money towards your down payment. So you save from year 1 to year 15, you save every single penny of that interest because you just pull that entire graph forward 15 years. And now your remaining payments are going to only be from year 15 to year 30. You're no longer responsible for all this interest payment. All you did was pull that graph forward, and now you're making payments from this moment on. That is why I always tell our clients that it's very important, if you can do it, to do this strategy. It'll save you so much money, and you'll pay your mortgage off so much quicker if you do this. And that's also why you hear some people talk about, well, put one extra payment per year towards the balance of the mortgage. This is exactly what they're doing, because they know that when you put that one extra monthly payment towards the mortgage per year, you're pulling that graph forward ever so slightly, and you're saving yourself money on the interest because it's moving the graph forward into the future and reducing the balance of the principal, because the way they calculate the interest is based on the balance of the principal, not based on the timeline. It's just based on how much is left owed on the mortgage, and that's how we calculate the interest that is paid for that year. That's how they do it. So putting that money towards the balance of the mortgage will save you so much money on the actual interest.